Here we are, part 3 of demystifying the loan process, and today, sitting here with Michele Brandt from Fairway Independent Mortgage, we're going to get a little technical. I'm Eric Lundquist with MRG Realty Partners. How we doing?
We're great. How are you?
Sweet.
Awesome.
All right, so from pre-qualified, what is the rest of the process? And you do pre-approval.
Yeah.
So from pre-approval,
Okay,
what's the rest of the process?
So from pre-approval, I kind of look at it as kind of a toss the potato. What is that game? Pass the potato.
It's the hot potato. Nobody
Sure.
wants it.
Oh, well, okay. So that's a really bad analogy then. But
The baton.
Passing the baton. Thank you. That's a much better analogy. So it goes from me to pre-approval. I get them pre-approved, educated to know what next steps. Then it goes to you as the realtor to find them the house.
Right.
Once you find a house, you key in on it. I come back for payment information, how to structure the offer. Then it goes back to you to make that offer, get the purchase agreement signed, approved. You kind of do your thing with home inspection, all that stuff. And then once we get that fully executed purchase agreement, and know that it's moving forward because inspection contingency is cleared, we take that and we run with it until the closing day. So there's a lot of behind the scenes stuff. I have a team of 5 in my office where we work day in and day out to get these loans through the process. So once we get the purchase agreement in, we'll want to get the loan disclosed, we'll want to get the loan locked, and then we'll want those disclosures to be signed by the buyers. And that's all electronic because in this day and age it needs to be.
Yep.
Once we have the packaged file together, we get all updated documents if we need new pay stubs because they've expired, bank statements, if a tax year rolled over and we didn't have the tax returns yet, we'll get the most recent tax return. We'll order the appraisal, we'll order the title work from the property. We want to make sure with an appraisal that it's safe and livable for that buyer and that it's worth what they're paying for. We don't want a buyer to buy a house for $200,000 if it's only worth $180,000. It's not in our best interest for a lender.
And that's something I like to tell buyers is when they're wondering is there's 2 risks that a bank looks at: the borrower and the property. So with the borrower, you have all that analysis piece, all of their documentation and their disclosures that you give them, and you mitigate the risk on the borrower to make sure they have creditworthiness, the ability to pay. And then you have the property, which you order an appraisal on, and you make sure that the title's clear.
Correct.
Right?
Yep.
Okay.
Yep. And we want the title to be clear of any defects.
Yep.
If there were any unpaid judgments, loans, we want to make sure everything's paid off and clean and clear for the next buyer.
Yeah.
So then once we collect all that data, we send it off to our underwriter. Underwriters work at Fairway Mortgage. They're not here locally in our office, but it doesn't matter because everyone's virtual anyway.
Yep. And
we have a 4-hour underwriting turn time. So as long as we get a file in by 2 p.m. Central Time, we will have a loan approval that same business day. So an underwriter's going to thoroughly look at everything that's in the file. Doesn't have to have an appraisal and title in it yet, it just needs to be ordered. They're going to look at the credit worthiness of the buyer, and then they're going to approve it generally with conditions. So maybe we missed, explain why you were late on that credit card last December.
Right.
Just a letter of explanation needed, or maybe we don't have a homeowner's insurance proof yet, or just minor little conditions like that. But the sooner we get it into underwriting to know exactly what's needed to get the loan clear to close and ready for the closing table, the better. Because I want to see exactly what this underwriter's after and looking for so that we can get those conditions working. So then as we get that conditional approval with conditions, we get the conditions from the buyer or the agent. Sometimes we need an agent to send us, the earnest money check or whatever that may be. We package that all together again. By that time, we'll have the appraisal and title in, and we'll send it back to the underwriter with okay, we got all those things that you asked for. Here you go. Yep. And then they'll come back again 4 hours later and issue a clear to close.
Yep.
That means you're done with underwriting. They'll never look at your file again. They won't ask for anything else. You are clear to close, ready to go. From there, we take it to our closing agents, the title companies, and we work with our closers at Fairway to prepare those final numbers and final documents.
Yep.
And then we get that off to closing.
So as realtors, how can we make the process more smooth? One thing I like to do is make sure that everyone is communicating through email and phone. I've got both title companies, I got the lender and both agents working and their assistants that they have. And is there anything through the process that we can do to make it smoother?
I think just explaining to buyers exactly what this looks like. I think a lot of buyers are confused once they think they're pre-approved. They think they're done. Like, what do you mean you need another pay stub? Why? So just knowing that, okay, now you're gonna get through underwriting and they might ask for more stuff, and the sooner you get them the stuff, the faster we'll move through the process.
Yep.
It can be a really stressful process for buyers because they don't know what to expect. If you don't have a good mortgage lender realtor team that, feeds off of each other and kind of, we kind of finish each other's sentences for these buyers, you feel like you're just looking over the edge of a cliff like, oh gosh, what do I do next? I'm not really sure. So, to just educate them to know that we gotcha, you're going to close, it's going to be okay, and they're probably going to ask for things. The sooner you can get them, the better. Yeah. If I have unresponsive buyers, the first thing that I'll do is go to the realtor.
Okay.
Because they'll sometimes respond to you and not to me, or to me and not to you, and so we just all work together to get that stuff.
So during that process, are there peak times where you're typically asking for a lot of things? So normal close, a purchase agreement gets accepted, and then you've got the close date, and that's generally about 30 days.
30 days, yep.
So where in there is like communication like the most?
Upfront for sure.
Okay.
So and that's tricky for the buyer because they've just done a whole bunch of stuff with you, with the purchase agreement, the earnest money, and the inspection, and all that stuff. So time sensitive, and then they get it to me, and it's almost like they think they're done.
Right.
And then they get their laundry list from me, and that can be overwhelming because I know already what an underwriter's going to need. So does my processor, Ashley. And so she's already expecting everything. And so she lists everything. Right. You need insurance. You need, to sign the disclosures. Let's lock your rate. I need another pay stub. I never got those tax returns, all of the pages. And so that probably right up front. And if a buyer's responsive right up front, smooth as silk. Cool.
So we talk about that underwriter, you talk about the AUS, but this is a person that's combing over everything. What does that look like, and where are they, and who do they represent?
Yeah, so the underwriters work for Fairway Mortgage. They're W-2 wage earning employees from Fairway all over our United States because we're the 4th largest lender in the nation right now, $20 billion. And so they are, so we lock a loan and we prepare that loan and package it up with a specific set of criteria. Let's say a Fannie Mae Home Ready loan, which is a 3% down, doesn't have to be a first-time home buyer, but it's got lower mortgage insurance and a lower interest rate. They know and pull the guidelines to know that there's lower income limits, there's, depending on the zip code, and so they pull all of their knowledge and tools together and thoroughly review. I mean, they're looking page by page, line by line at all deposits that come into your bank statements, and they're looking at all of that stuff and determining, is it an approvable loan that we can sell after to, whoever we sell the loan to, or is it something that isn't going to work?
Okay.
So.
All right. So third parties, how do third parties dictate the process?
Sure. Yeah, there are a lot of outside sources that are out of our control that we sometimes don't get to know until we're in the process. You can only go so far before you are prepared and then not prepared. So, for example, let's say a buyer's purchasing a condo and they're planning on putting 5 or 10% down. They've got great credit. We've approved them or pre-approved them. They look great. Write an offer, comes back, it's accepted, etc. We have to do, when there's less than 20% down, a full condo review. If a condo review comes back and it's not approvable, time out, we've got a problem that we need to solve.
Sure.
So those third parties sometimes make us ebb and flow, and that can create extra stress in the process. An appraiser, this is a hot topic right now in this busy spring market where not everything's caught up. The appraisers will sometimes go, it's such a crazy market with houses just flying off the shelves, going over the list price, and those appraisers sometimes won't appraise the homes at the value. And then that is a third party that we really can't control until that appraisal comes in. That might be 2 or 3 weeks before closing, and now we've got a house that's not worth what we need it to be worth. Sellers and buyers expecting it, and all agents and everyone to expect that, and we gotta work together to come up with a solution. So sometimes the best of intentions on a clean file, the third parties control it sometimes, and it's out of our hands, but we do a really good job of trying to bring everyone together to come up with a viable solution.
And so when you order appraisal, you're actually going to some third-party company to do it, because you can't have any interaction
right,
with
yep.
that appraiser, right?
Yep, a few years ago, HVCC came out, and that required us not to have any contact. Lenders could not contact appraisers. So we don't even get to know who the appraisal is. We send our stuff off to this company called FLS, Frisco Lending Services. They find the appraiser. It's an approved appraiser, so it's not any Joe Schmo off the street. They've got to meet criteria.
Yep.
But they send it to them, they accept it, they give us a deadline and a date, then they contact the agent to get into the house, inspect it. We get the report back, and that's when we get to know who it was.
Yep.
And then if we have an issue, we still can't talk to them about it. It has to go through this management company.
Got it.
Mm-hmm.
So another thing I wanted to talk about is assumable loans. So I want to get a little bit technical. Government loans being assumed. So sometimes I get the question, because I deal with VA borrowers who are selling their house.
Yeah.
Can a VA loan be assumed by a non-vet? And how does that work?
It can be assumed by a non-vet. Common misconception that VA loans have to be assumed. And I'll back up and say what an assumable loan is. So an assumable loan is a loan that, let's say Eric's got an assumable loan and he's selling his house. And I'm a buyer that wants to buy his house. Let's say his interest rate was fixed for 30 years at 3.5%, and my interest rate that I can get from my realtor or my lender right now is 5. Mm-hmm. As long as I qualify, meaning my credit's pulled, my income looks good, my assets look good, I can assume Eric's loan at 3.5%. So I assume the terms. Mm-hmm. Eric signs a release of personal liability so that if I stop making payments, he's not liable, and I get 3.5% interest rate on a 30-year fixed loan, because that's what VA loans are typically, 30-year fixed. So that's the assumability function. It's a little lengthier process, like a 60-day process versus a 30-day closing process, because you have to go through your current lender servicer. So the lender, like myself as a lender, I couldn't do an assumable loan for somebody.
So whoever's owns my loan at the time.
Right, so if you're paying like JP Morgan Chase,
yeah,
we have to work through them to do the servicing and to do the assumability. But VA loans are assumable, and you don't have to be a vet, and FHA loans are assumable as well, generally. And there's no criteria for that either, just call it.
Okay, so what about other government besides VA? How are they assumable?
So in FHA loans, generally assumable, the fixed loan.
Okay.
Occasionally some conventional ARMs, the adjustable rate mortgages, not a fixed rate, but an adjustable rate are assumable. Although I don't know why you would want to assume an adjustable rate mortgage. That's an option. I actually have a lot of folks that, so the kids are buying a house and they just barely don't qualify for a mortgage. Okay. So we add parents as non-occupying, meaning they're not living in there, co-signers to the loan. Yep. And it's an FHA loan. And then knowing that in 6 months or a year or whatever the timeline looks like, we will get the parents assumed off. So you don't have to refinance it, you just do the assumability, and the kids assume the loan from the parents, and then they're released of liability. You do that a lot, so that it's not such a long term, you don't have to refinance it in current interest rates.
I wish I could do that with a car.
I know.
All right, cool. So let's talk a little bit about adjustable rate. When is it the right time for a borrower to do an adjustable rate, and what does that really mean?
So an adjustable rate mortgage is something that is fixed for a certain period of time. There's a 3-year, 5-year, 7, and 10 typically. Okay. So let's use the 5. That's probably the most common one. Okay. So a 5-year ARM is what they call it, is fixed for the first 5 years or 60 payments. Okay. It will not change for those 60 payments. It's amortized over 30 years, so it's still a 30-year loan, but it's just fixed for 5. Okay. The start of that 61st payment, it will adjust. It can go, this is generally speaking with ARMs, this is probably 95% of all ARMs. It can go up or down up to 2 points. So let's say you lock into a 3% 5-1 ARM, 5-year ARM. 5 years with 3%. The start of that 6th year, it can go up to 5%, down to 1. It won't go down to 1, but it could go up to 5%. Let's use worst case. Yep. Then it's 12 months fixed at 5%, and then the start of the 7th year, it can go up another 2 points to 7. And at the start of the 7th year, it can go max is 5 points over what you lock in. Yep. So it can't go over 5 points over, but it can adjust, and then it fixed for a year. Yep. So it's not like it adjusts monthly, but it can adjust once a year. Yep. Very, very risky if you aren't careful with it. a lot of people see that interest rate and see that savings and think it's a great idea, but you really need to have your plan in place.
Yeah.
So what happened with the mortgage meltdown is people were going into these ARMs because we were in such an appreciating market and they thought they could just refinance later.
Right.
Well, then we went into this depreciating market and they couldn't get out of these loans and the
Going
interest
up.
rates started. Yeah.
Yeah.
So it's something that I do still have people that do it. A lot of folks that do it are the financially savvy, that if they ended up with a pretty large down payment, that if they ended up in a position of depreciation, they could easily find an exit strategy and not be, in a foreclosure situation.
Got it. For someone who maybe knows they're only going to be around for 3 years or 4
Right.
years and live in the house for that short a period of time,
Yeah.
maybe that's a good way to go.
With the larger down payment, so they know if there is a depreciating risk,
They
they're
can
still going to be
refinance.
able to refinance or sell. Yep.
Got
Because
it.
these people were stuck. I mean,
Yeah.
they would sell it if they could, but they couldn't even sell it.
Yeah.
And they're stuck with this high payment and no way to get out of it. So I always say be very careful. The one 5-year ARM I've done in the last 5 years, he was a financial planner. He wanted a 5-year fixed loan because he just wanted no loan in 5 years. And we don't have that. The shortest term we have is a 10-year fixed. So he opted for the 5-year ARM and amortized it over 5 years and just made those 60 payments and it was paid in full. Now it was like an $80,000 loan, so we're not talking, $300,000 or anything, but he really wanted to get a plan in place that was 5 years and he was done with his mortgage.
Okay.
That worked out really well for him because he saw a 2-ish% interest rate as opposed to, the fixed one, which was higher.
Yep. Can we talk about some line of credits?
We can.
Tell me like a couple of cool products that people can do in refinancing.
So, I will say that the most popular one I think people don't know about is called the fix-up loan.
Okay.
It's not just for first-time home buyers, but it is through Minnesota Housing, so it's a Minnesota Housing Bond Program.
Okay.
And you can use it as a homeowner to fix up your property, and you can borrow over 100% if it's an energy-efficient fixer-upper, and it's a secured loan at a fixed rate, so it's
Right.
generally 5 to 6% interest rate.
When you say 100%, explain that so everyone knows.
So 100. So let's say you bought your house for $200,000.
Yep.
And it needs a new roof, and you don't have cash for that, and it's a $20,000 roof. As long you can borrow up to 125% of the home's value, so you
Got
can
it.
borrow more than what it's worth for this energy efficient improvement
Got it.
on roof.
Yep.
You couldn't put in a spa, a hot tub,
Right.
Things like that, but anything that would improve the home is a really nice feature. That's a fix-up loan through Minnesota Housing. A lot of people I've got right now trying to get creative with how to be non-contingent to be most competitive, and so we're utilizing like pulling lines of credit on their properties or bridge loans on their properties to be able to exercise the ability to have the funds
To buy the next house.
to buy the next house without having, and then qualifying with all the payments, of course, without having to worry about, I've got to sell, I'm really sorry, this is a contingent offer, because
Right.
it generally won't get accepted.
Yep.
So a lot of folks
Awesome.
are doing that, which is really cool.
Anything else technical you want to talk about?
Construction financing is kind of a cool
that's a good
feature
one.
as well.
Yeah.
So what I love doing, I've got this buyer right now, they're remodeling their cabin, and they don't quite have enough equity to just pull a line of credit.
Mhm.
So we can utilize the future value of the house with the improvements and get a construction loan on that future value.
Okay.
So the house right now is worth $250. They're putting 50 grand in. It'll probably realize about $100,000 worth of value because of the improvements they're doing.
Okay.
So we can use that higher value and borrow more money against it for that project. And then turn around, and what we do, construction loans are temporary. They're generally 6 to 12 month loans that balloon. So
Right.
then we provide a really, really affordable refinance on that construction loan.
Okay.
And I've got a great relationship with my construction lender, so we just say, this file is good, here's the file, and then we'll close those in a week.
So-
really fast.
So a common question is probably going to be, if I do that, can I do the work myself?
Sometimes yes, it depends on if the work needs permits and if you have any sort of background in that work.
Okay.
You generally speaking need to be in the trades
Yeah.
of some sort. If you're a plumber and you're building a house, maybe, because you probably have all the connections.
Sure.
If you're an insurance broker and you're buying a house, building a house, probably not.
Right.
They want to have.
Is there any arm's length? Like if my brother's a general contractor,
arm's
can I
length
have
for
him
both,
come in?
Absolutely. Yep, that's fine.
Awesome.
As long as everything is all in writing and up to par and looks good for the lender and we've got an approvable end loan. That's all they care about.
What
is
about in a
making sure
town
we
that
pay.
doesn't necessarily need permits for stuff?
Yeah, that's fine.
Yeah.
I mean, I had an HVAC guy that got approved to build his own outbuilding.
Yeah.
So, I
Okay.
mean, yeah, it's just, the bank is small and we have a great relationship with them, and so they know that we'll get the end loan done, and so it's very low risk for them. And that generally requires 10% equity. So let's say you buy a lot
Yeah.
and sit on it for a year and it realizes some equity and then you
Sure.
want to build on it, you can utilize that lot equity and not actually need the 10% cash out of pocket.
Okay.
I have a lot of people that do that
Cool.
as well. They just sit on the lot and realize the equity
Very
that way.
cool.
Yeah. Fun
Well,
stuff.
there you go. A couple of technical aspects about loans, and that wraps up our 3-part series. Thanks, Michelle.
Thank you. I
All
love
right,
it.
All right. Fairway Independent Mortgage and MRG Realty Partners. Also, the Uncommon Hero Project. Get some money back from us if you're a cop, firefighter, vet, healthcare worker, or teacher. See you soon.
Thanks.